Here's a number that should make you angry. $1.2 million. That's how much less the average woman will earn over her lifetime compared to a man doing the exact same job. But here's what's even more disturbing. It's not just about earning less. Women are also investing less, taking fewer risks, and building smaller portfolios. And the result? The wealth gap between men and women is actually wider than the income gap. We're not just earning 84 cents on the dollar. We're accumulating maybe 50 cents of wealth for every dollar men accumulate. Now, before you click away, thinking this is another depressing statistics video, stay with me. Because what I'm about to show you is not just the problem, it's the solution. I'm going to introduce you to 3 women who cracked the code. One manages billions for the ultra-wealthy at JP Morgan. Another built and sold a company, and now runs a $3 billion global business. And the third started as a waitress's daughter, and built a financial empire. And here's the best part. The strategies they use to build wealth aren't complicated. They're not reserved for the rich. And you can start using them today, even if you're starting from zero. By the end of this video, you're going to understand exactly why women struggle with wealth accumulation, what successful women do differently, and the 3 specific actions you can take this week to start closing your personal wealth gap. Let's dive in. The brutal truth about the wealth gap, the statistics nobody talks about. Okay, let's start with the hard truth that most people don't understand. You've probably heard about the wage gap, women earning 84 cents for every dollar men earn. That's real, and it's a problem. But here's what's worse, the wealth gap. A recent study found that women control only 32% of global wealth, despite making up 50% of the population. And when you look at who's building serious wealth, the kind that creates generational security, the gap becomes a canyon. Only 10% of Fortune 500 CEOs are women. Only 2.4% of venture capital funding goes to female-founded companies. And according to McKinsey, at the current rate of change, it will take 50 years to close the economic gender gap. 50 years. That means if you're 30 years old right now, you'll be 80 before we reach parity. Your daughters will inherit this problem. But here's where it gets interesting, because the women who do build wealth aren't waiting 50 years. They're doing something completely different. And I'm going to show you exactly what that is, why this happened. The promotion gap. Jennifer Openshaw, who went from being raised by a waitress working 2 jobs to becoming a financial powerhouse, said something that hit me hard. Men get promoted on promise. Women get promoted on performance. Think about what that means. A man walks into his boss's office and says, "I think I can do this job," and he gets the promotion. He gets the opportunity. He gets the higher salary. A woman has to prove she can already do the job often by actually doing it for months or years without the title or the pay before she gets promoted. The result? As we go up the corporate ladder, the wage disparity actually widens. Women at the top might have the same qualifications, the same hours, the same results, but they're earning significantly less. Why? 3 reasons. First, women tend to be placed in softer roles: HR, communication, operations, instead of roles directly tied to revenue generation. And the revenue-generating roles, those pay more. Second, women are underrepresented in the highest-paying industries: technology, law, finance, and engineering. Third, women negotiate less aggressively for their salaries and promotions. There's decades of research showing this. We undervalue ourselves. We wait to be offered, instead of asking. We accept the first number instead of pushing back. Now, before you think this is all doom and gloom, here's where the story changes. Because the women I interviewed discovered something powerful. The saver versus investor problem, the story that changes everything. Sukendra Cassidy, who runs Xero, a $3 billion global accounting platform, told me a story about her 2 kids that perfectly illustrates the wealth gap between men and women. Her daughter is a diligent saver. She keeps every penny she earns. She tracks expenses. She refuses to even tell her mom how much she has saved, but it's substantial. She's disciplined. She's responsible. Her son? Not so much. He spends money. He's not naturally a saver. But here's what happened. Sukendra convinced her son to invest. She told him to pick 3 stocks, anything he knew about. He picked Nvidia, Apple, and a Bitcoin fund. He didn't do deep research. He just picked companies he'd heard of. Within months, he was up 50%. Her daughter still has all her money sitting in a savings account, earning maybe 0.5% interest. So who's building wealth? The son, who was less disciplined but willing to take smart risks. Here's the lesson. Saving is not the same as investing. And being risk-averse is not the same as being financially responsible. This is the core problem with women and wealth. We are incredible savers. We're disciplined. We're cautious. We're responsible. But we're not investors. And in a world where inflation runs at 3 to 4% annually and savings accounts pay less than 1%, being a saver actually means you're losing wealth every single year. The numbers don't lie. Let me give you a concrete example of why this matters. If you want to have $1 million by age 65, a 30-year-old who invests needs to put away $35,000 one time. That's it. Compound interest and market growth do the rest. A 50-year-old who waits needs to put away $239,000 to reach the same goal. That's nearly 7 times more money because they started 20 years later. Starting early isn't just helpful. It's the single most powerful wealth-building tool available. But here's the problem. Women start investing later than men. We keep money in savings longer. We wait until we feel ready or knowledgeable enough. And every year, we wait costs us exponentially. So how do you overcome this? How do you shift from being a saver to being an investor without taking reckless risks? That's exactly what we're going to cover next. The Smart Risk Framework. Invest in one. You know, Sukendra shared something brilliant about how she built her personal wealth. She said, make money in what you know. Her first job was as an investment banker working on savings and loans. Not sexy, but she learned the business inside and out. The first 2 stocks she ever bought, thrift stocks, and she made money. Then she moved to Silicon Valley and worked in e-commerce. So she invested in e-commerce companies as an angel investor and in public stocks. Many of those investments paid off massively. Later, she joined the board of Xero and deepened her understanding of retail. So she invested in retail businesses where she could see the patterns of winners versus losers. The lesson? You don't need to be a Wall Street genius. You need to invest in industries and companies you understand. Do you work in healthcare? Invest in healthcare companies. Do you love technology and use certain apps every day? Invest in those companies. Do you understand in retail, fashion, or consumer goods? Start there. Building a smart risk portfolio. Here's the framework that all 3 of these women emphasized. Don't put all your eggs in one basket. Sukendra made this mistake early in her career. She took money from one startup, Amazon ironically, and put it all into one other stock based on a broker's recommendation. Bad move. One stock to one stock is gambling, not investing. Instead, build a portfolio. 1. Safe foundation. 40 to 50% of your investments. Index funds or ETFs that track the overall market. These grow slowly but steadily and are extremely low risk. Examples: S&P 500 index funds. Total market funds. 2. Growth investments. 30 to 40%. Individual stocks in companies you understand and believe in. Focus on 5 to 10 companies across different industries. Research them. Understand their business model. Track their performance. 3. High risk, high reward. 10 to 20%. Startups. If you're an accredited investor, emerging technologies, cryptocurrencies, if you understand them. Real estate investments. Jennifer Openshaw gave a perfect example. After selling her company in Silicon Valley, she invested in real estate. There was risk, for sure, but she did her research. She understood the market, and she tripled her wealth in 5 years. That's the power of smart risk taking. Now, you might be thinking, this sounds great, but I don't have a financial background. How do I even start? That's exactly what I'm going to answer next, and it's simpler than you think. The practical game plan. Step 1. Get financial literate fast. Malik Santini, who manages wealth for ultra-high net worth clients at JP Morgan, emphasized something critical. Education is the foundation of everything. You need to understand the basics. What is debt, and how does it affect you emotionally and financially? What does retirement actually cost, and what do you need to save? How does investing work? What's a stock? What's a bond? What's an ETF? What are your financial goals and how do you align your money with them? Here's the good news. You don't need an MBA in finance. You need to understand the fundamentals. Resources to get started. Books. The Simple Path to Wealth by J.L. Collins. I Will Teach You to Be Rich by Ramit Sethi. Apps. Greenlight, for teaching kids and learning yourself. Acorns, Robinhood, for beginning investors. Podcasts, So Money with Farnoosh Torabi. Afford Anything with Paula Pant. Dedicate 30 minutes a week to learning. In 3 months, you'll understand more than 80% of people. Step 2. Know your worth and negotiate. Jennifer shared a story about a friend who discovered a new hire, same qualifications, was making more than her. She spoke up, and her compensation changed immediately. Here's your action step. Research what people in your role and industry actually earn. Use sites like Glassdoor pay scale levels, FYI, especially for tech. LinkedIn salary insights. Then have the conversation. Don't wait for your employer to offer. Ask, script, based on my research and the value I bring to this role, I believe my compensation should be. Can we discuss adjusting my salary to reflect that? It feels uncomfortable. Do it anyway. Every $5,000 raise you get now compounds over your entire career. Step 3. Start investing this month, not next year, not when you feel ready. This month. Here's how. If you're a complete beginner, open a Roth IRA account, Fidelity, Vanguard, or Schwab. Start with $100 a month. automatic transfer. Invest in a target date retirement fund, an S&P 500 index fund. Set it and forget it. If you have some experience, open a brokerage account. Pick 3 to 5 stocks in industries you understand. Invest $500 minus 1. To start, track performance quarterly, not daily. If you're more advanced, diversify into real estate, REITs, or rental properties. Consider angel investing in startups. If accredited, explore alternative investments like art, collectibles, or crypto. 5 to 10% of portfolio max. Step 4. Build your financial team. Malik emphasized this. You don't have to do this alone. Successful wealth builders surround themselves with experts. A financial advisor, fee-only fiduciary, not commission-based, a CPA or tax professional, and estate planning attorney. Especially as your wealth grows, a community of other investors, online forums, local groups, mentors. At JP Morgan, Malik's team looks at the entire financial picture: assets, liabilities, estate planning, retirement, taxes, everything interconnected. You might not need that level of sophistication right now, but the principle applies. Get smart people around you. Now, before we wrap up, I want to share the 3 pieces of advice these women would give their younger selves. Because this is where the wisdom really hits. Wisdom from the top, what they wish they knew earlier. I asked each of these women, what advice would you give your younger self? Jennifer's answer: be in your power. She said she used to get nervous walking into meetings with wealthy, successful people. She would doubt herself, question whether she belonged. Then she learned to talk to herself differently. To remind herself, you deserve to be here. You've earned this. And that mental shift changed everything. She also said, visualize what you want. She started doing this at age 12. Visualizing meetings, visualizing success, visualizing the life she wanted, and she built exactly that life. Sukendra's answer: calm down. It's all gonna work out. She laughed and said she was incredibly intense when she was younger. Still is, but worse back then. Her advice: trust the process. Invest in what you know. Build a smart risk portfolio early. And she said, don't do what I did. Don't take all your money from one startup and put it in one stock a broker recommends. That's idiotic. Learn from her mistake. Diversify. Always. Malik's answer: become a subject matter expert in one area. She said the key to becoming irreplaceable and therefore highly compensated is to go deep in one specific area. Not broad, not generalist. Deep expertise. When you're the person everyone comes to for one specific thing, your career trajectory accelerates exponentially. Pick your area, master it, own it. The call to action: your wealth gap starts closing today. Here's the truth. The system isn't designed to help women build wealth. The wage gap, the promotion gap, the investment gap, they're all real, and they're all working against you. But here's the other truth. You don't have to wait 50 years for the system to change. You can start closing your personal wealth gap today. Your 3 actions this week: 1. Research your worth. Spend 1 hour on Glassdoor, PayScale, or Levels.fyi. Know what you should be earning. Then schedule a conversation with your boss. 2. Open an investment account. Roth IRA, brokerage account, doesn't matter. Just open it. Transfer $100. Buy 1 index fund. You're now an investor. 3. Invest in what you know. Pick 1 company whose products you use every day. Research it. Understand the business. Buy 1 share. Start learning. That's it. 3 actions this week. Because the women who build wealth don't wait for permission. They don't wait to feel ready. They don't wait for the perfect moment. They start. They take smart risks. They invest early. And they build the life they visualize. The question is, will you? Drop a comment below telling me which of these 3 actions you're taking this week. Subscribe, because I'm breaking down more wealth building strategies every week. And share this with one woman in your life who needs to hear this message. Let's close the wealth gap together.